Hello, everyone. What a crazy week or two we've had here. So I'm breaking our tradition of doing a YouTube video on Employment Day and doing it midway through. We want to be there for our clients, and we want to share our point of view. We do have a point of view on what's going on. Both economically and market-wise. So as usual, we'll go through monetary policy, fiscal policy, some economic indicators, market indicators, and then we'll go into a lot of worries that the market's having right now. The impact of rising rates, the impact of Treasury Secretary's point of view on the crypto markets, Bitcoin in particular. We'll go into the liquidity of the market, especially ETFs. We'll talk about inflation versus deflation. And finally, a word about the financial system generally, and comments from Thomas Petterfee, who is the chairman of Interactive Brokers. Some of his thoughts, we talked to him recently as well, and wanted to share them with you. And then we'll have a final word on innovation, although it will be shorter today because there's so much going on that we want to address. So on monetary policy, pretty easy, still with Fed Chairman Powell's testimony this week in front of Congress. We see that the Fed is nothing but supportive. And we see M2 growth still up in the mid-20s, very rapid rate of growth, so very supportive monetary policy, and the chairman emphasized once again that they're focused on two things: full employment, and we are far away from that. And then inflation above 2% and consistently above 2% on a year-over-year basis. We are not there yet. We're in the 1.5% to 2% range. So nothing right now suggests that the Fed is going to tighten, except for maybe the markets themselves. And we see other indicators perhaps calling for some changes at the Fed in terms of tightening up monetary policy. We see commodity prices really moving up very rapidly, especially copper, and especially copper relative to gold. So copper is the commodity with the PhD, as many people often say, and gold is more of the safe haven or inflation hedge. So to see copper going up that rapidly against gold suggests there are animal spirits out there. The dollar is going down. Housing prices are moving up at a double-digit rate, which is pretty astonishing. We've seen very strong asset market prices when it comes to stocks generally. We're still up for the year, even after the recent turmoil. And of course, we've seen action in the cryptocurrency space, pretty dramatic action. And yet the Fed is not responding to any of those, not yet at least. There are some indications in the market, because the market actually does lead the Fed, that the Fed will respond sooner than most believe, but we'll get into that when we talk about markets. On fiscal policy, well, thanks to budget reconciliation, we're probably going to get a package. It could come today, may already have come, in the $1.7 to $1.9 trillion range, so $1.7 to $1.9 trillion. That's pretty astonishing. It does not include the $15 minimum wage, which was originally in the bill, although that may be added to what looks like a $3 to $4 trillion infrastructure bill brewing. So think about that, almost $2 trillion now, and then another 3 to 4 trillion on the way. Now, anyone who has read about guns and butter in the 60s, that was during the Kennedy and Johnson regimes, knows that we will have to pay for this in some way, shape, or form. We would like to think that that the economy will grow its way out and that innovation will be a big part of the solution. But there are a lot of other investors out there who are very worried about leverage in the system. And we'll get into that as well. You know, we've just seen the $600 billion. This is not even part of this $1.9 trillion package. We've seen $600 billion in stimulus money making its way into the system. We saw that in today's personal income report. So disposable personal income was up 11.5% month to month. That's not year over year, that's month to month. If you annualize it, it's up by much more than 100% annualized. Pretty provocative. Spending was up 2.4% month to month again. Again, that's not annualized. So times 12, you know, almost 30%. And we're seeing the saving rate, because the income growth was so much stronger than the consumption growth, the saving rate went back to 20.5%. At the peak in the crisis, it was up at about 35%, but it had been coming down month by month. And we thought it was going to slip into the single digits. It did not. It has gone back to 20%. So again, the consumer has a lot of firepower here. And, you know, I would say the economy is on fire. I know we're not at full employment, and yet all of the leading indicators that we think are so important are on fire, and they have very high multipliers associated with them. And this is particularly true of housing. Just think about how much other spending a home purchase causes. And same with capital spending. Capital spending is really strong right now. It has been forced into action by the coronavirus, this move towards the digital everything, which has accelerated innovation beyond the rate at which we or most observers would have expected. So capital spending and housing have two of the highest multipliers in the economy, which means that a dollar spent causes more dollars to be spent, and again, a virtuous cycle. So we already think the economy is very strong, and we believe that the markets are now saying, okay, the economy is really strong. And what happened this week, and I think what shocked the equity markets to some extent, certainly the higher valuation part of the equity markets, was it looks like interest rates continue, long rates continue to go up. We got to 1.6% yesterday, I think, on the 10-year Treasury bond yield. Now, at the beginning of this year, many bond investors thought we'd have trouble getting through 1. Now it looks like we could go to 2 pretty easily. I will say, based on indicators, mostly if you look at short-term traders, there are measurements of their activity. There have been record shorts placed on the bond market. So they've been playing the momentum here as interest rates go up, prices go down. So traders have been shorting the bond market at record rates, and I looked back as far as 20 years. So we probably are in for a little bit of a pause here in the movement of rates going up. For that reason alone, there's too much bearishness out there. So we do know that 1.6% from 0.5% during the crisis, that is a monumental move in the bond market. The volatility in the bond market is beginning to outpace that in the equity market. And I think one reason for that is bonds have been in a bubble. And the search for yield became extreme. And so bond bubbles or any bubble, when it bursts, seems a little chaotic. And a tripling in the bond yield from the bottom has to feel like nothing bond investors have ever felt. What we're also seeing in the bond market is in the 2-year and 5-year range, the so-called belly of the curve, we're seeing those interest rates move up as well. Now, they had been held down for the most part because the Fed was saying, we're not going anywhere. We're not going anywhere. But now they're not being held down. And this could be the beginning of the market leading the Fed. Historically, that has been the case. The market has led the Fed. And what this could mean is the economy is so strong that the markets are now saying, okay, we don't need this quantitative easing. And the Fed is going to come to the same conclusion pretty quickly. So let's anticipate that move. So here we are. We think that move is on the way. Now, this also reminds me of the late 2016, early 2017. And at that time, the quantitative easing was on its way out, and the Fed was going to start raising interest rates. They had telegraphed that, and the market was very nervous. And I remember one of the reasons it was very nervous was after President Trump won the election, the odds of a cyclical burst increased because of his promise to cut taxes. And that's exactly what happened. But in the beginning, the equity market responded, was very nervous around this idea that interest rates would be going up. And what happened is when President Trump was elected, value stocks took off. Just like they're taking off now, responding to this idea that this economy is developing ahead of steam. So the value stocks have taken off. And in fact, if you look at year to date, I think financial stocks are up 27%. And energy stocks are up 27%. Financial stocks are up about 11%. I think technology stocks, if I'm not mistaken, are up basically 1%. And healthcare, which is another area in which innovation strategies, or to which innovation strategies are exposed, that's actually down. So traditional value stocks are having a nice run here. And how do we feel about that? We feel really good about that. Just like we did in 2016, when we said value is up, and actually the market was up, value up even more, and growth strategies like ours were down. They were actually in negative territory back then. And I remember saying at the time, I think this is great. I think it's great because the bull market is broadening out to other sectors. And that can only be a good thing for us. What would be very negative for innovation-based strategies is if the market continued to narrow so that only innovation strategies worked, because that's what happened during the tech and telecom bubble, and we all know how that ended. There was too